Hello, ACCA students. I hope you are fine wherever you are. I am your number one ACCA tutor, Mr. James Timkulu. In this video, I'm going to go through Section A type questions which you are likely to face in your upcoming financial management exams. So, um, without much ado, please allow me to go straight uh, to the business of the day. But before I start to work through the questions, I want you to have an appreciation. Maybe this is your first time to sit for this examination. Okay, the paper is going to be tested uh, in 3 hours or under 3 hours. Okay, and it is a computer-based examination, which means by now you should be practicing attempting this question on the ACCA practice platform. Okay, remember all questions are compulsory, which means you need to show the examiners that you are ready to pass across all sections. If you get 100% in section A and then you failed in section B and C by bigger margins, then there is a likelihood that you're going to fail. Okay, now the way to compulsory simply means that you need to put extra effort in all the sections. Okay, for example, we know that section A has got 15 questions which are worth 2 marks each. So it means that in section A, you are required to score 30 marks. In section B, there are 3 questions, each containing 5 objective test questions, which means these also are going to be worth 30 marks. And in section C, these ones, there are 2 20-mark questions, which means they are worth 40 marks. So let's say, for example, in section A, you have obtained 28 marks. In section B, you have obtained something like 27 marks. Okay, let me just say 28 marks. All right, so this gives us a total of 56. And then you decided to say, oh, since I've passed already, I know that I've passed section A and B tremendously, so therefore I just have to relax, and you obtained 2 marks in section C. If you add this up, they give you 58 marks. But in the eyes of the examiner, because you have shown that you were not prepared for section C, you are likely to get 46 or any mark below 50%, because you'll be showing examiners that you are not yet ready. All right, the other point is that both sections A and B are going to be tested from every angle of the syllabus. However, for section C, you are going to be tested on working capital management, investment appraisal, and business finance. So you need to be well prepared before you sit for this examination. And I hope this video is going to assist you with your preparation. Now, these are the areas of the syllabus you should focus on. Of these, I think this one I've mentioned, the working capital management, the investment appraisal, and the business finance. These are the topics you are going to meet in your section C. Okay, but all of these are going to be tested across the syllabus. That is for questions which are in section A and B. So don't be shocked to see an investment appraisal question in section A. Also, a working capital management question in section A or B. Okay, the examiner simply said that for those long questions, these 3 topics are going to be tested. However, they are also going to be tested in any part of or in any section of the paper. All right, so you need to be prepared, well prepared. Now, I think we should then go straight to the questions with this background. We have got this question, ladies and gentlemen. The inventory ordering policy of ZACCO is to order 100,000 units when the inventory level falls to 20,000 units. The cost of placing and processing an order is $200, while the cost of holding inventory is 50 cents per unit per year. Orders are received 1 week after being placed with the supplier. The production requirement for the next year, that is 50 weeks, is 600,000 units. What is the cost of ZACCO's inventory ordering policy? So, please, this statement is not saying what is the cost of ordering. It is saying what is the cost of inventory ordering policy, of ZACCO's inventory ordering policy, which means the examiner is requiring you to come up with the total cost, which includes the holding as well as the ordering costs. All right, and also remember that within the holding there is the buffer holding cost, the buffer inventory holding cost. You need also to think of that. Why? Because when we place an order, we need to wait for 1 week before the order is received, which means we can't stop production in that particular week. We also need some buffer inventory, which is going to give us some flexibility while we'll be waiting for the order. Okay, so now your task is to identify the variables, or to identify the meaning of those figures. For example, you are told that the ordering policy is to order 100,000 units when the inventory level reaches 20,000. So obviously 100,000 is the order size, which is also the economic order quantity. Okay, that's our economic order quantity. It has been worked for us by the examiner, so we need not to worry about it. However, you should get into that example knowing that the economic order quantity formula is given, which is equal to 2 COD over CH. Okay, that's the formula. Now let us slot in those variables. We can see that we are having this particular 200, which is the cost of placing an order, and this is our CO, and also the cost of holding each item of inventory, which is the CH. What about the 20,000? What is this figure? This figure is the reorder level, or the reorder quantity. Okay, our reorder level. All right, now we have got these, and we are also we have also talked that or stated that there is also some buffer inventory to worry about. Okay, now let us calculate the cost of the units for the buffer. How many units should we keep in stock as buffer inventory? We know that we are going to order, so let me say buffer should be the 20,000 units, okay, minus, okay, the buffer should be the 20,000 units minus the usage in 1 week, and the usage in 1 week is given by the annual demand. Okay, the annual demand, we have determined it to be 600,000, okay, divided by the length, that is 50 weeks. So we want to determine how much are we going to consume in 1 week. Remember, we are going to wait for 1 week. So we need to divide the total number of units we need annually by the total number of weeks for us to determine how much units do we use in 1 week. So this gives us 20,000 minus 8,000. Please verify with, not 8,000 but 12,000. Okay, and when we then deduct 12,000 from 20,000, we are left with 8,000. So these are the buffer units. We need to ensure that when we are processing our orders, we also have to consider that there is a waiting period of 1 week, which means we also need the 8,000 units to be aside. Okay, so normally we are not going to wait to have the exactly 20 units for us to process an order, but it is then advisable to actually process an order when they reach 28,000 units. Okay, because we need to ensure that we have the 8,000 units ready. Okay, now what is that background knowledge is important. That is not going to take us to the answer. We have only calculated the buffer units so that when we calculate the total cost, we will consider the buffer inventory as part of the holding cost, because these buffer units are units which would have been already considered when we placed the previous order. Okay, so they are part of the holding costs because they are part of inventory which should be considered as units under custody, which for which the holding costs apply. Okay, so we then come here and say holding costs. We need to compute these costs because they are also part of the inventory policy cost. Okay, so our holding cost should be given by, remember we need to average. Okay, so it's given by the CH, okay, from our EOQ formula, the CH multiplied by the average inventory, and average inventory is Q or EOQ divided by 2, or just Q divided by 2. So we know that per cost the inventory was the holding costs were 0.5 dollars per unit, okay, multiplied by the average quantities, okay, or the average inventories, or the average order size, actually the average quantities in each order. All right, so we know that the quantity or the EOQ was 100,000 units, because we are told that the policy is to order 100,000 units each time when an order is placed. Okay, so this gives us how much? That's 50,000 divided by 2, that's 25,000. These are now dollars, remember. Costs are in dollars. All right, and then we have to consider the buffer inventory. Buffer inventory, we know that these are 8,000 units, so we multiply by the cost per order, the holding costs per unit, multiplied by the 8,000. These 8,000 units are not going to be halved as we did on the ordinary holding cost. Ordinary quantity. So we are going to have a total of $4,000. And then we move on to the ordering costs. The ordering costs, ladies and gentlemen, are going to be the CO from the EOQ formula multiplied by the demand over the order size or the quantity or the EOQ. All right. So, oh, that is noise here. So, this would take us to the cost of ordering from the question was $200 multiplied by the demand, which was 600,000, divided by the quantity or the order size. Okay, and this should be here. It's 1 here, that's 6, so that's 1.2 $1,200. So let us add all these figures from 25 up to 1.2. That's 25 plus 4, that's 29, plus 1.2, that's 30.2. So that's 30,000. So the total costs of the inventory policy was 30,200. Okay, that was the answer there. So you can see that you need to have a lot of practice and to understand what will be going on, because it's not going to be an easy walk in the park to pass this paper. Let us move to the next question. Okay, there is this question, ladies and gentlemen, I want you to also appreciate. The following are extracts from the financial statements of INS Corp. We have got revenue of 2.780 million, cost of sales 1.612 million, inventories 226 million, trade receivables 417, trade payables 198. 10% of INS Corp sales by value are on cash terms. This is a very important note. Purchases for the year totaled 1.451 million. Assume a 365-day year. Calculate INS Corp's inventory holding period, trade receivables collection period, and trade payables payment period. All calculations should be to the nearest day. Okay. Remember, these are periods, so they can't be in dollars, so these are days. Okay, and you're told that use a 365-day year, which means when you use any other figure other than 365, for example, if you use 360 or if you use 366, you are likely to come up with the wrong figure. Okay, so use what the examiner has instructed you to use. Now, let's start by calculating the inventory holding period. So inventory holding period is equal to the inventory itself divided by the cost of sales multiplied by 365, and you get your figure. All right, so let us because we need to illustrate the rounding everything. So the inventory was 226 divided by the cost of sales 1612 multiplied by 365 days. Okay, this should give us let me use my calculator here. Where is the calculator? Because I'm using slides, on slideshow, there it might take us time. So that's 226 divided by 1612 multiplied by 365. we are getting 51.172 days. But the examiner has said your calculation should be to the nearest day, which means this should come up or come down to 51 days. Okay, that's your rounding. Now I just want to give you the formulas for the trade receivables collection period. Sorry. The collection period is given by the receivables themselves. Okay, the trade receivables divided by the credit sales multiplied by 365. Now, there is a problem. People get confused because in financial accounting, trade receivables are credit sales. Okay, but for the purpose of this formula, trade receivables, we know that they are credit sales. However, for the purpose of this formula, trade receivables are outstanding credit sales, outstanding or unpaid credit sales. Are we together? The unpaid credit sales. Now, these credit sales now, which are the denominator, are that revenue, the revenue that was not paid for in cash. Okay, the revenue that was not paid for in cash. Now, there could be some confusion, but we are saying this figure, the revenue figure, includes all the sales which were made during the year. However, some of the sales were paid for by cash, whereas others were through credit. But it doesn't mean that by the end of the year, those which were bought by credit were not paid for by the end of the year. No, it doesn't mean so. So I want you to differentiate the credit sales outstanding and the credit sales which were made during the year. Credit sales which are outstanding are the ones we are calling trade receivable, because they are not yet paid for as of end of year. But the total credit sales, or those sales which were bought on credit, or which were made, or which were given out on credit, are the credit sales which are the denominator. So these are the sales made on credit, regardless of the fact that by the year end, some of them were paid for and they were no longer receivables. Okay? But at some point, they were receivables, but they were cleared. But now, for the purpose of this formula, we are simply saying that the receivables, or who are the denominators, they are the receivables outstanding at the end of the year. Whereas the credit sales, which are the denominator, are part of the revenue figures, but which were from the sales made on credit. Having that background, I'm sure we can now slot in the figures. Okay. Okay, now, so going ahead, we can see that our total receivable, our trade receivables collection period would be the trade receivables we are having were 470. So 470 divided by the credit sales. Now the credit sales, we are told that 10% of the sales figure given were made um, on cash, okay, on cash terms. So which means the credit element, the credit sales were this revenue figure multiplied by 90%. Okay, so that's 2780 multiplied by 0.9, we get to 502. Then you multiply by your 365 and you get your figure. For the trade payables, payment period, the trade payables payment period should be the payables themselves, the trade payables, divided by the purchases, not by the cost of sales. Students make that mistake. Please don't make that mistake. It's divided by purchases, multiplied by 365. So your purchases figure was given there and your payables figure was that. So that's how you were supposed to have attacked this particular question. So all the question, I mean, all the all the answers were required. So you were supposed to get the days for the inventory holding period and the days for the receivables and for the trade payables. Okay, if you were going to score all the marks. Now, question number 3. Beach litter is a charity that was set up with the objective of cleaning litter from all beaches within the local area. So this was a charity with an objective of cleaning litter from all beaches within the local area. Which two of the following performance measures would best fit with effectiveness in a value for money audit? Okay, so remember the measures for VFM measures, these are 3 E's. The 3 E's, we have got economic, we have got effectiveness, and efficiency. You must not get into that exam hall without knowing these 3 E's. Okay? Now, the economic, here we are looking at minimizing the cost. Okay? Effectiveness, we are looking at the results of the product itself. All right? Now, efficiency, we are looking at how the inputs were turned. Okay? How well the inputs were turned into outputs. All right? So that's what we'll be looking at in general. All right. So the question is saying these guys were having an objective of cleaning the beaches. Now they want now. The examiner is saying which of the following are measures for effectiveness. And when the question says which two, it means that if you only pick one, even if it was correct, you're going to fail that question. You need to pick 2 correct choices. That's the, when the examiner says it's compulsory, it means that you need to be very serious. If you pick 3, when he says 2, you're going to fail the question. And by the way, these are objective test questions, which means only 2 will be correct. Only 2 choices will be correct. Now, let's look at the options. Average hours worked to clean each beach. Does that speak of any effectiveness or any product? Because effectiveness is about the results. So even if you give us the average hours worked, doesn't tell us about the product. So A is out. Okay? A is out. What about B? number of beaches awarded the government's clean beach certification. You can see that this is now a product. It is speaking of the product that has been given a clean beach certification. So B is correct. Let's look at C. Average annual expenditure on each successfully cleaned beach. Does that talk of the product? This one is just speaking of the cost. So we can actually relate C to economy. All right, the economy of it. All right, average annual expenditure. Average annual expenditure. Okay, the economy is actually stopping here. However, when we then look further, then we are seeing the efficiency. Average annual expenditure on each successfully cleaned beach. Yes, the word successfully here is now talking about the operational efficiency. Okay, the operational efficiency. All right, so we can actually say C is talking of efficiency, but not the product itself. All right, now what about D? Average hours worked by each volunteer per month. This one again is not telling us about the product. Our product is to clean the beaches. Okay? So the product could be seen in the clean beach itself, or beaches being certified clean, or the amount of litter cleared. Because this was actually our objective was to clear the litter. So the amount of litter cleared each year measured in tons. Then we can actually say we are being effective. So A and B were the answers. ABRA has 6% convertible loan notes in issue with a floor value of 106.2 per 100 loan note. Each loan note can be converted into 15 ordinary shares at any time or redeemed in 5 years' time at nominal value. Okay, so this one is actually a common. These questions involving convertible loan notes are very common exam questions. So you need to be prepared to face them. So here, I just want to present this one, and there should be another one that I'm also going to present of the same caliber. What is the minimum share price at which investors would convert their loan notes to 2 decimal places? Now, the examiner here is a little bit tricky, but he is not that tricky. All right, investors are only going to convert, or to vie for the option of converting the bonds into shares when they see that it is a favorable option. So the floor value, okay, is actually the present value of the redemption option. Okay, so for these guys to go for the conversion, right, they should see it, attractive. So we are now regressing, or we are now matching the two values, 106.20 versus the redemption value of 100, because the loan notes are going to be redeemed in 5 years' time at nominal value, which is $100 per loan note. However, here we are told that the floor value is 106. The floor value is actually acting as the market value of the loan note, right? Or let me just say the present value of the option to convert. So if they are going to convert, obviously they're not going to use this. They are going to convert at this amount, which is going to give them more money. So they need to convert. If they are converting today, this should give us, this should give us a value that makes sense. So the conversion value is now going to be 106.2 divided by 15. $106.2 over 15. That's $7.08. So some of the questions you need not to waste much of your time. Remember, the examination is a 3-hour, but those 3 hours is not, they're not a long time. Now, a typical one. This is now a question which we are all used to. LUCO has 8% convertible loan notes in issue, which are redeemable in 5 years' time at their nominal value of 100 per loan note. Alternatively, each loan note could be converted after 5 years into 70 equity shares with a nominal value of $1 each. The equity shares of LUCO are currently trading at 1.25 per share, and this share price is expected to grow by 4% per year. The before-tax cost of debt of LUCO is 10%, and the after-tax cost of debt of LUCO is 7%. What is the current market value of each loan note to the nearest dollar? So your task here is also going to be the skill of maneuvering. There are certain distractors which you are going to face in the examination. For example, which choice shall I, which cost of debt shall I pick, the before tax or the after tax cost of debt? Remember, when you look at this, you should look at them in the eyes of, or in the shoes of the investor. Now, if you are looking at the items in the eyes of the investor, then you should be considering the pre-tax or the before-tax cost of debt, not the after-tax. Because the after-tax is relevant to the company, not to the investor. So you need to stand on that principle. Anyway, before we go there, let us talk of the choice between conversion or redemption. That's the main business. Okay, now, as usual, we are given 2 choices to make. All right, the choice between conversion and the conversion versus the redemption. And for redemption, we are told that they are going to be redeemed at par, that is at $100 per loan note, or the conversion. But the conversion, in this case, we need to work it out. So we are told that they are going to be converted into 70 shares, and the market value of the share today is $25, but it is expected to grow. Okay, it is expected to grow. All right, and the percentage of growth was 4%. So we need to multiply by 1.04. Right, each year up to year 5. So we then have to power this figure by 5. All right. So that's the power 5. All right. So what is the total figure we are looking at? Let us use our calculators. 70 multiplied by 1.25 multiplied by 1.4 to the power 5. So this should give us 106.457. So if you are comparing the two figures, you can see that the conversion route gives us more money, right? So what then shall we say? We need then to calculate the present value of that option. So the PV of the higher is equal to $106.457, okay, multiply by the present value factor. The present value factor 5 years at 10%. Present value factor 5 years at 10%. Let us use our we are going to be given some I guess some discount tables. So present value 5 years at 10%. So this is the figure we need. All right, that's the figure we need. 0.621, 0.6. Sorry, all these questions, ladies and gentlemen, were prepared for you. 0.621. So we're going to multiply this figure and this by that figure, and that should give us something like calculator. All right, 66.10987708. Okay, and we also have to consider the interest charge. Okay, ladies and gentlemen, I want you to appreciate this. The present value of the higher value of the conversion value is the amount we expect, or the value of the shares in 5 years' time. Okay, the value of the shares in 5 years' time. Okay, so this is why we need to bring that value to today. All right, in today's terms. So this bond will also incur what we call interest. All right, there are some interest charges associated with the bond. So we are going to pay 8% interest. Okay, so it's 8% of $100. 8% of $100 multiplied by 100. That's the nominal value of the bond. So it means that annually we are required to pay $8. Okay, but we also have to factor in the discount. Okay, because we are paying this annually. So the 8% is actually, the $8 is an annuity. All right, the 8% is an annuity. Okay, and like I said, here we are going to use the before tax cost of debt. Okay, the before tax cost of debt. So we are going to require the annuity factor. Okay, annuity factor, 5 years, 10%. Why 10%? Because that's the pre-tax or the before-tax cost of debt. So we do the same. We go to the annuity tables now. Why are we going to the annuity tables and not the present value tables? Before this, I had gone to the present value. Why did I go to the present value? Because I was looking at the value of the bond in 5 years today. Okay, but now I then require annuity tables in this case. Why? Because the $80 is being paid annually in equal installments. So instead of calculating the present values for each year, I can just use the annuity table. So I'll do the same. Okay, that's the 5-year line and the discount 10%. So we're going to intersect at 3.791. That's the annuity factor, 3.791. Okay. So I need to multiply 8 by 3.791 and I should get 30.328. Okay, so this will give me the value of the bond today, which we call the market value of the bond. So the market value of the bond should be the present value of future cash flows. That is 96.43787708. And the question says to the nearest dollar, which means your answer should be $96 only. You need to round it down. Okay, so that's the market value of the bond, or the current market value, as the question says. Let us now do one more question. Okay, let us do one more question. A state-funded hospital has the objective of providing value for money. It measures the achievement of this objective using the 3 E's: economy, effectiveness, and efficiency. Which of the following performance indicators measures the hospital's economy? To what extent were we minimizing costs? So, number of patients admitted per year, does that have to do with costs? Total medical staff salary cost. This one has to do with cost. So this one, A is wrong, but this one is correct. What about C? Let's see. Cost per successfully treated patient. We are looking at, you can see that here is now more of efficiency. How well were we turning inputs into outcomes or into outputs? So this one again is not. Then average waiting time for patients admission to hospital. This one again speaks nothing about the economy or the minimization of costs. So the total staff salary cost speaks of the economy of our processes. Okay, so you need to practice this value for money. You know, it's painful to fail such questions in an examination because there would be actually uh, questions which are said to be giveaways. All right, um, that's it. Um, let us continue. Okay, a machine costing 450,000 has a useful life of 6 years, after which time its estimated present value of resale will be 25,800. The present value of the total running cost over the next 6 years is 82,200. The company's cost of capital is 10%. What is the equivalent annual cost of using the machine if it were bought and replaced every 6 years in perpetuity? Okay, now you need to understand one thing. The equivalent annual cost is just the same uh, subject area related to the computation of um, the net present value, or rather present values. Excuse me. So there is nothing new there. It's only that we are now computing the present values in the uh, cost dimension, not in the positive dimension towards the computation of NPVs and so forth. So, for example, we need to know, to determine the present value of the machine utilization cost. Okay, so the utilization, the cost of buying machine is normal. The outlay, we just write it as normal, the way we write it in the computation of an NPV. So the outlay was 450,000. Okay, but we are told that every year this machine is having running costs of um, 82,208. Remember, these are PVs. PV of running costs, PV of outlay. Now, the PV of outlay usually is going to be the same figure because the outlay is done in year zero. Okay, in the first year, not in the first year actually, but in at the start of the project. So that's the discount factor is 1 for that. Okay. All right. So usually the outlay is just multiplied by 1. So which means we normally multiply the figure by 1 because it is deemed that the discount factor in year 0 is 1. Then these other ones, that's where you need to refer to the tables. Then we are also told that there is a recovery value when we resell. The resale PV of resale was the resale value was 25,800. So while the running costs are negative, this figure is going to be positive. Remember, the annual equivalent cost, or the EAC, equivalent annual cost, should be the present value of the cash flows. Right? The present value of the cash flows. So the present value, the total present value here should, divided by the annuity factor. All right. So in total, the cost, the PV of costs, if we add up those figures, we should arrive at 506,480. All right. Now, we then have to determine the annual, the equivalent annual cost, which should be 506,480 divided by the annuity factor 6 years. Remember, it's 6 years here. Annuity factor 6 years at 10%. So we go back to our annuity table. The annuity table, this time it's 6 years, 6 years at 10%. So we are arriving at this particular figure, 4.355. So we are going to use that figure divided by 4.355. So we are going to have the value of 116, okay, 116,299. So in financial management terms, the cost of operating this machine is $116,299 annually, okay, in present value terms. So if we continue to use this, it means that forever we are going to incur $116,299 of costs. All right, ladies and gentlemen, let's continue. A financial manager believes that if information regarding his organization is made public, it will not affect the share price, as this information is already reflected in the current share price. In terms of capital market efficiency, to which of the following does the financial manager's belief relate? Now, this manager is comfortable that whatever the gossip would say, we do not care, because we believe that the share price is actually reflecting all the information our shareholders or potential investors should know. So everything is already in the public domain. So what type? The examiner is actually giving you the hint that this guy is operating in a market or in an economy which is of strong form efficiency. Okay, why? Because the public, the information is readily available everywhere. So the share prices are not going to be affected by whatever gossip. All right, because the public knows everything. So information is readily available to the market. So they are operating in a strong form efficiency. Are we together, ladies and gentlemen? Okay. Let's move on to this particular question. Okay, guys, we are now on question number 9. And the question is saying, Kayako is expecting to borrow 25 million in 3 months' time. The loan will be for a 4-month period. Okay, so the loan amount to be borrowed is 25 million, and the period for borrowing is 4 months. Kayako is concerned that interest rates could rise over the next 3 months. Okay, so it wants to fix the rate of interest now with a forward rate agreement. So this is a FRA and has obtained the following quotes. So these are the quotes from the FRA supplier. The FRA supplier has quoted us with this information. So this is the information provided. So actually we are having two FRAs here, and we just have to decide which FRA do we need. But the choice is going to be informed from this paragraph. Okay, that's where we get the information. Now we want, let's say today it's 0, but we want to take the loan in 3 months. So the loan is going to be taken in 3 months. Okay, over what period? Over 4 months. After which we repay it back. Okay, so which type of FRA do we need? Obviously, if we are going to require the loan in 3 months, so we are going to have a FRA that starts with a 3 versus the versus here is the end period. The end period when we have to return or to repay the loan. Okay, so if it is if the loan is for 4 months but taken in 3 months, we are going to say the versus here is the 3 plus 4. 3 being the start of the loan, start month, and the period. So we are going to have a 3v7, which signals that we are going to take a FRA in 3 months, but it is going to be for 4 months. So that's 3 plus 4, that's 7. So it's a 3v7 FRA. 3v7 FRA. Okay. The first one here, this first one was implying that it is a FRA taken in 3 months, but for 1 month. Okay, for 1 month, which was 3v4. Okay, so this is not the FRA we need. We want the FRA that speaks of the 4 month period. That is a 3v7. Are we together, ladies and gentlemen? Now, after we have identified that, we then have to ask ourselves, which rate are we going to use? Okay, let me clean up the space. Which rate are we going to use? Because here the examiner has not been generous with us. He wants us to be real, not fake financial managers. So we are given two rates here, the 4.7% and the 5.0%. We are only going to know which particular rate to apply after we understand what is going on. In this case, we are going to borrow. Okay, so if you are borrowing money from the bank, obviously the bank is not going to let you be on an advantage. Okay, he wants you to pay more interest. So he's not going to allow you to pay the 4.7 interest, but he will allow you to borrow at the higher percentage. So we are going to use the higher percentage, which is 5%. Okay, so the 5% is going to apply in this FRA. Now, after we have identified this, we then have to say, assuming the interest rate is 5.3% in 3 months' time, what will be the financial settlement? Remember, a FRA is taken today to set a fixed rate which is going to apply in the contract. So we have set the fixed rate at 5%. Okay, but in 3 months' time, the rate has been determined to be 5.3. So the question is saying, how much is going to be the settlement? Remember, if the interest rate increases in 3 months' time, it means that the supplier of the FRA is going to settle us or to compensate us for that difference. So the difference here is the 5.3% minus the 5% multiplied by the loan amount, which we have determined to be 25 million, multiplied by the period of the FRA, which is 4 months, 4 over 12. And we get how much? Ladies and gentlemen, let us use our calculators. Okay, you can just pause the video and do the computation on your own to determine the the calculated value. So obviously we are going to get a settlement of 25,000. And our answer is A. Okay, just replay this part of the video and you'll be sure that you have assimilated enough information to make you ready to pass this ACCA exam. Let us go to the next question. Shadow company orders goods from a foreign supplier. A payment of 400,000 is due to the supplier in 4 months' time. The financial manager is concerned that the cost of the goods may rise in dollar terms and has decided to hedge the foreign currency risk of the payment due. The following information has been provided by the company's bank. Okay, so they fear that the cost of goods may rise in dollar terms. However, they want to pay 400,000 pounds. Okay, so for them to pay 400,000 pounds, they have to first buy dollars. They need to buy to buy pounds. Okay, they need to buy pounds for them to be able to pay. However, this could be a very expensive arrangement if the pounds, gain in value, and it might become expensive in dollar terms. Okay, so they need to enter into a 4 months forward rate, forward market hedge. Remember, this is currency hedging. Okay, the FRAs are for interest hedging, but now this is a currency hedging, so we are going to use a forward market hedge. Are we together? So they need to buy pounds. So if they are going to take a 4 months forward market hedge, then they need to pick the applicable forward rates given here. So which one do you think should be the appropriate rate to use in this hedging? Just pause the video and do the picking by your own. Okay, now I've already indicated that these guys, they needed to buy pounds for them to settle the payment. Okay, they are operating in a dollar environment, but for them to be able to buy or to pay or to settle this liability or with this supplier, they need to buy pounds. Okay, now you also have to know that in risk management, the bank is always going to be at an advantage. Okay, so in this case, the rate at which the payment is going to be made is at that rate where the suppliers of the pound or the pound sterling are going to benefit. So using the two rates, this rate and this one, you can see that the lower rate is going to enable the buyer of the sterling to be required to pay more. Okay, so in this case, they need to buy 400,000 pounds divided by 0.775, which is the rate that is going to that is going to require this shadow core to pay more dollars. They are going to pay more dollars. All right. If we use this rate, it means we are going to allow shadow core to pay less. So we have to use the lower rate so that shadow core pays more. Okay, that's the trick. So how many dollars are they going to pay? They are going to pay 400,000 divided by 0.775, which means they are going to pay $516,129. That's the payment. Are we together, ladies and gentlemen? Don't make mistake of multiplying that 0.775 with the 400,000. That will be a misinterpretation of the scenario. Okay. All right. Let's move on. Now, we have question 11. Match the characteristic below with the appropriate working capital strategy. Okay, ladies and gentlemen, this is the question which we have been given by the examiner. Okay, and he's testing your understanding of working capital strategies. Okay, the working capital strategies, and you are given two of them. Two core, and they are further branched into their conservative and aggressive categories. Okay, we have got the investment, and financing strategies in the working capital context, and these are further grouped into aggressive and conservative. Now, you just have to show the examiner that you understand the difference between aggressive and conservation. Okay, aggressiveness speaks or has a bias toward taking higher risk, whereas conservativeness or conservation talks more of stability of returns, okay, taking minimal risk and so forth. All right, so those individuals who are conservative in approach, they tend to be risk averse, whereas less risk. Okay, I think we need to tabulate the background of these theories. Okay, so those in favor of conservation, who favor the conservative working capital strategy, they tend to focus on maintaining high levels of liquidity and minimizing risk. They tend to prioritize uh, cash flow security, um, and stability. Typically, uh, the conservative approach uh, involves holding high cash levels and inventory. Actually, it's synonymous with all uh, stable business attitudes. All right, like for example, paying bills, paying bills early. That's a conservative approach. Okay, it's a conservative approach. Their idea is to the idea is to prevent negative business consequences like stockouts. They don't want a situation of the business running out of stock or being labeled late. Late bill payers. They don't want such bad publicity. All right, or to have a cash flow crisis. They don't want a cash flow crisis to occur. The proponents of conservative working capital strategy, they don't want cash flow crisis or stockouts. All right. So, which companies are suitable for this strategy? Um, it's suitable for companies who are operating in a turbulent environment where the sales are unstable, okay, or where there is high uncertainty and limited access to credit. Okay, uh, suitable in high uncertainty. They don't want to take much risk because of this uncertainty, limited access to credit. Okay, and the sales are unstable. So if the sales, sorry, I don't know what happened here. Um, okay, excuse me. The sales are unstable. What about the aggressive working capital strategy? On the other hand, the converse is true. Okay, here we'll be minimizing idle resources. We don't want cash to be just idle or inventory to be idle and so forth. Okay, so in other words, we do not want current assets to just, we don't want more of those current resources, current assets. So minimizes idle resources and maximizes returns. They believe the higher the risk, the more the returns. They prioritizes they prioritize efficiency and profitability at the expense of liquidity. typically involves lower levels of current assets. Current assets includes inventory, cash, etc. Okay, so it's suitable in a just-in-time environment or suitable in um, environments where the sales are stable, low uncertainty, and there is access to credit. When we need money, we get it. That's when we can adopt the aggressive working capital strategy. But if we are operating in an environment which is so dynamic, which is uncertain, and so forth, the conservative approach would be the best option. So now, with this background, let us then attempt this question. Let us match these characteristics with the appropriate working capital strategy. So you can move from the working capital strategy to the characteristic, or from the characteristics to the working capital strategy. The examiner doesn't care. All right, just have to ensure that you pick the relevant boxes, or you choose the relevant boxes. So let us move from the working capital strategy to the characteristic. Now, conservative investment strategy. Now, I didn't speak about investment and financing because they tend to be synonymous in the working capital situation. Okay, investment is all about the risk and returns, whereas financing is much about gearing, much about the leverage. Okay, shall we go for more debt, or shall we be financed internally using retained equity, retained funds, or shareholder equity, like through the issue of shares, something like that? That's financing. All right. So in the working capital context, they tend to be, similar to some extent. Anyway, okay, let us try to make. So, as I've indicated, the conservation and aggressiveness are the keywords for you to attempt this question. So, a conservative investment strategy obviously is going to be an investment strategy that doesn't want to take much risk. Okay, so in that context, these guys, as you have already seen, they tend to have more current assets around them. Okay, so obviously they tend to have higher levels of current assets. Okay, so they tend to uh, be in line with that. Okay, and this one is also the appropriate strategy. Okay, what about for the aggressive financing strategy? Obviously, they also tend to have large amounts of short-term finance. All right, they are aggressive. Whereas the conservative ones, they tend to require a relative small amount of short-term finance. All right. The other thing is that in conservative financing, we actually want longer term finance. All right, because the focus is on gradual growth. All right. So that was how you were supposed to have matched these. Sometimes the examiner would be giving you the answers straight before your eyes, but you might tend up to mix up things. All right, let's go ahead. Okay, here I've indicated uh, the solution, right? This was the solution to this question, but the important thing is for us to know how did we arrive at the solution. That's the most important thing, because on exam day, you're not going to get the same question or the same figures. A company has announced that it will pay an annual dividend equal to 55% of earnings. Its earnings per share is 8 cents or $0.80, and it has 10 million shares in issue. The return on equity is 20%, and the current cum div share price is $4.60. What is the cost of debt? So at this level, I'm sure we all appreciate the dividend growth model, which says that PO is equal to DO 1 plus uh, that's DO1 plus R, okay, or let me just say 1 plus G. G is the growth rate, okay, over what's happening with my pen here, over KE minus G. Okay, let me just confirm this from the formula sheet. It's been a long time. Yes, I asked the formula. Yes, it's only that I made in terms of using RE, I used KE, okay, but you can see that I was almost there. Now, in the examination, I urge you guys to, you need to use the formulas given, all right? Do not play clever before the examiners, because you might miss up a certain variable to the formula. So you need to use what formulas you are given. All right, so if when this formula is rearranged when we can use this formula to calculate the cost of equity. All right, and as you can see here, the cost of equity RE has been is given by DO 1 plus G over PO 1 plus G. So it's just a rearrangement of this formula. Okay, so that's the dividend growth model for you. We also need this particular formula for the growth rate. Remember that there is this particular G which we need for us to answer that question. Okay guys, we need everything in this box. As you can see on the screen, we need also this formula and these two formulas. We need them, this one and this one. All right, so let's proceed with our computations. Okay, so the question requires us to compute the cost of equity, and we have seen that when this equation is rearranged, it becomes RE. Okay, I used KE, it's just the same. RE is equal to, first of all, let us go step by step so that you understand how the how the formula was rearranged. All right, so it's KE, as you can see there. All right, and I said that KE is just the same as RE. Okay, so it's KE is equal to DO 1 plus G over PO. Why? Because we've moved KE on this side and taken PO on that side. I'm sure you've seen it. Okay, then we then have to remove this G to the other side. We need to take G this side, so it becomes KE. Remember, G was minus G on the left side, so on the right side should be plus G. So KE is equal to DO 1 plus G O over PO plus G. Okay. All right. Now, let us then try to slot in the figures. You can see from the question that, of course, we have information related to the share price, but the share price is cum div. With the PO here, this PO should be ex div. Okay, that's an ex div share price, which means we need to deduct the dividend, the current dividend. All right, now let's determine the current dividend from the question. We are told that the dividend is equal to 55% of earnings, and the earnings were 80 cents. So DO is equal to 0.80 multiplied by 55%. And this should give us how much? Let me use my calculator. Okay, so this gives me 0.44. That's the current dividend. Okay, what about, because we are also told that we need, in the formula here, we also want the G. Okay, this G, we need it. So G, we saw that G was BR. Okay, from the formula sheet. Remember, let me show you again, because the formula sheet should be your friend in the examination. Okay, there was this particular small formula. G is equal to BRE. Okay, G is equal to BRE. So the B is the earnings retained, okay, or the retention rate. The earnings which were not distributed, but the proportion of earnings which were not distributed. And the RE is the return on equity. All right. So with that in mind, let's continue with our computation. So I'm saying this B is the retention rate, and R is the return on equity. Okay, return on equity. How do we calculate return on equity? How do we calculate the return on equity? This formula, you might need it. Okay, it is the PAT over capital employed. All right, it was not required here, but you might be asked of it in other exam setting or in future questions. Okay, PAT, that is the profit after tax over capital employed. That's your return on equity. Okay. Okay. Excuse me for that. Uh, let me just correct this formula. It's over total equity. Sorry, I'm looking for the pen. It's not appearing. Okay. It's total equity. And equity includes the share capital, reserves. Okay, share capital and reserves also include the retained earnings. So that's the total equity we are talking about. So PAT over total equity. That's the formula for return on equity. Okay, um, so we have got R already. Now let's calculate the retention rate. Now, retention rate, we are told that dividends are paid at, are equal to 55%. So obviously the retention rate is 1 minus 55%, which should be 45%. So obviously our G should be, which space can I use? All right, G should be 1 minus 55%, that's 45%. So G should be 45% multiplied by R, and our R is 20% there, the return on equity. So the G should be 45% multiplied by 20%. And that should give us 45 by 2, that's 9. So that it should be 9%. So G is 9%. Okay. Now I'm sure we now have all the variables, and the dividend, the DO, we found it to be that one. So we are home and dry. We can go. So our RE or KE is equal to DO1 plus G over PO, okay, plus G. Therefore, the DO was 0.44 from our computation for DO, okay, multiplied by 1 plus G, and the G is 9%, so that's 0.09, or over PO. The PO which we are given is cum div. The examiner has pointed out that this was cum div, so you need to adjust it to become ex div. So that's 460. This one is a cum div minus the dividend that has already been paid, which is 0.44, plus G, which we have determined to be 9%. So let's load those figures in our calculators, and I'm sure we are going to get 25%, 20.5%. 20.5%. That's the answer, and this is why we obtained that figure. It was quite complex, but from the look of things, from the look of it, you can take the question for granted at first instance, but you realize that it's not easy to get the right answer. Okay, we've got that question, ladies and gentlemen. Adrian is contemplating purchasing for $60,000 a machine which he will use to produce 10,000 discs per year for 5 years. The discs will be sold for $9 each, and unit variable costs are expected to be $5. Incremental fixed costs will be $14,000 per year for production costs and $5,000 per year for selling and administration costs. Adrian is a discount rate of 10% per year By how many units must the estimate of production and sales volume fall for the project to be regarded as not worthwhile? Okay, here we are being indirectly required to calculate the sensitivity of a cash flow. Okay, the sensitivity of a cash flow. Now, we are told this particular cash flow should be linked to sales sales volume, production and sales volume. So which type of cash flow could that be, or which type of measure could this be? Obviously, this should be contribution. Contribution is related to sales volume. Remember, contribution is equal to sales less variable costs. Okay, so sometimes you need not to get into that exam telling yourself that I only want to answer questions linked to financial management, and you forget that you are also expected to have some knowledge of performance management. Okay, you need to have some cost accounting knowledge for you to pass this paper, because these philosophies are linked, they are just interlinked. So this is the idea. Okay, so ladies and gentlemen, you need to get into the exam hall knowing this formula. Sensitivity of a cash flow is equal to the net present value, okay, the net present value of the project all over the present value of the cash flow under consideration. So let us first calculate the net present value of operating this particular machine. So what was the outflow or the outlay? The machine costed 60,000. Okay, and what about the inflows in using the machine? The inflows were for how many years? Okay, they were for 5 years, and we are told that the sales were $9 and the variable costs were $5. So what is the contribution here? 9 minus 5, that's contribution is got $4 per unit. And we are told that they were producing 10,000 discs. So the inflow is 4 multiplied by 10,000, 10K. This gives inflows of 40,000 every year. The 60,000 is an outlay, so it should be negative. What other information do we need? There were incremental fixed costs. Okay, in the computation of these NPV, we need to consider incremental cash flows or variable cash flows. So we'll be using the same principles of relevant costing. Okay, so incremental fixed costs are going to be relevant, so they will be included in the computation for the NPV of the project. Okay, so we are going to consider the 14,000 as well as the 5,000. The selling and administration costs. So other costs, in brackets 14 plus 5,000. So this should be 19,000. Okay, the 19,000 should be considered, and remember, these cash flows, the contribution are annual cash flows, as well as those other costs, the incremental costs, are also annual costs. The examiner is saying that per year. So they are annual, they are annuities. Okay, so being annuities, you then have to use the discount factors here you are going to use are going to be different. You might use the PV here, the PV factor, but obviously even if you use the annuity factor, it will be 1 for year 0. All right, but for these other ones, you're going to use annuity factor. So the annuity factor which we are going to use for the inflows and other costs is going to be 5 years, 5-year annuity. At what rate? Did the examiner give us a rate? Yes, they said 10% discount rate. So annuity factor 10%. 5 years 10%. So we can consult our tables. Yes, this is the annuity factor, 10%. Obviously, the 10% is a very common figure, 5 years. So that's 3.791. 3.791. Here again, 3.791. Okay, then you get your present values on the side. So that's 60,000 multiplied by 1 will become 60,000. This dollar sign should not reflect a lot of zeros there. So 60,000 negative, and 40,000 multiplied by 3.791. This should be 15164. So that's 15164. These are commas, ladies and gentlemen. 151,640, and 19,000 multiplied by 3.791. This should be 72,029. 72,029. So if we add up, this is a negative. If we add up these figures, we're going to be resting at 19,611, which is a positive figure. So this is our NPV. Now the sensitivity of the contribution. Sensitivity. Remember, I said the inflows here is the contribution. How did we get the 40,000? We first used the sales figure of $9 minus the variable cost of $5. So that's 9 minus 5, and we arrive at $4. And we use that $4 to multiply it with 10,000 discs, and we arrived at this 40,000. So the sensitivity required here is for the contribution. Okay, so sensitivity is going to be the NPV 19,611 divided by the present value. The present value of the inflow, the contribution was this one, which was 151,640. Okay, we multiply it by 100%, and we get 12.93%. But the question was not requiring us to come up with a percentage. It wants the actual sales volume. By how much should the sales volume fall in units. Remember, it's saying by how many units. So we need to then change that figure, that percentage, to units. In unit terms, this comes to 12.93 multiplied by the annual production of 10,000 units. And this should be 1293 units. And you then have to see it by yourself that the answer was B. Are we together, ladies and gentlemen? Let's proceed. Now let us consider that important question. The following summarized financial statement for Radilant. We've got statement of financial position as at 31 December 2025. Okay. And they said assets, the asset totals were 200 and they were balancing with the equity side. We had ordinary shares and reserves. Profit after tax for the year ended 31 December 2026 was $20. Dividend, that is a 40% payout, was $8. So $8 was the dividend and this was the profit. Statement of financial position is at 31 December 2006. So this was 2005 and this is 2006. The assets were totaling that much and the reserves were that much. Okay. If the company's return on equity and earnings retention remain the same, what will be the growth in dividends in the next year? Okay. So you can see here that in 2006 they made a profit of 20. All right, so I'm just interested in the movement of reserves. Initially, the reserves were 100, okay, but this was the figure brought forward from 2005. Then in 2006, they made profit, this $20. So this should add to the reserves, but they then deducted a dividend. Okay, they paid 40% of the dividend. 40% of 20 was 8. So $8 was deducted. So we say minus 8 here, and we arrive at this particular figure. Are we together, ladies and gentlemen? Are we seeing the movement? Good. Now, if the company's return on equity and earnings retention remain the same, what will be the growth in dividends in the next year? Okay, so we are being required here to compute the growth rate. Okay, so with the information given, we can actually see that the formula which is relevant for the determination of the growth rate is the Gordon's growth rate, which is equal to G is equal to BR. Okay, and I've said that B is the retention rate, whereas the R is the return on equity. Sometimes it is called the accounting rate of return. So return on equity, we said that this is given by PAT over total equity. Okay, PAT over total equity. However, you must then know that if you are given two statements of financial position, you are going to use the opening balance for return, for the total equity. You are going to use the opening balance sheet values. Why? Because we want to assess the return of that equity over the financial period. So we are going to say the ROE, the return on equity, is going to be the profit after tax, which was $20 as given, over the opening equity balance of 200. Okay, multiply by 100%, and we are going to get 10%. Okay, and our retention rate, our B, is going to be, because dividend is 40% of the earnings, so obviously the earnings retained should be 1 minus 40%, which is equal to 60%. 1 is almost like, 1 is equal to 100%. Okay, so 100% minus 40%, that's 60%. So it's so simple as that, isn't it? Okay, now we have both of the variables. So our G is going to be the B, which was 60%, multiplied by the R, which was 10%. And this should give us 6%. So simple, isn't it? Let's continue. What is the effect on a UK-based company when a foreign competitor's currency becomes weaker compared to the sterling? This was a giveaway question, and these 2 marks were actually some grant generosity. Okay, now let us use our common sense. Obviously, there is going to be an effect, so option C is wrong outright. Now we are left with A and B. A is saying the foreign company will have an advantage in the UK market. B, the foreign company will be disadvantaged in the UK market. Now, we are saying that these companies are vying for the same customers. All right, this is why they are saying that the companies are competitors themselves. But there's one company that is operating outside the UK and another company that is UK based. But they are all vying for the same market. So when the currency in the competitor's country has depreciated, it means that the customers in the UK are going to find that company's product cheaper. So it gives that company in the foreign country an advantage over the companies who are operating in the UK. So our answer will be A. Are we together? Let's move on. Now, which of the following is most consistent with maximizing shareholder wealth? We're given a lot of confusing statements. However, this one is wrong. Why? Because it doesn't mean that having higher profits, we are increasing shareholder wealth. Sometimes we would end up, sacrificing the wealth of shareholders because of that imperative. Remember, we have cases of companies whose accountants manipulate earnings For example, if you keep a lot of closing inventory, you are going to have higher profits, but that inventory might not be sold. And by the end of the day, the wealth of shareholders will be at stake. So profit maximization is not consistent with the shareholder wealth maximization principle. What about market share growth? If we grow our market share, yes, there could be some advantage in terms of business growth, but it doesn't necessarily mean that we are going to ensure that by the end of the day, the wealth of shareholders is going to be guaranteed. So this again is not. Minimizing the cost of capital. Now, when we minimize the cost of capital, obviously we are going to increase shareholder wealth. Remember, shareholder wealth or the market value of the company is equal to the future, the present value of its future cash flows. Okay, discounted at WACC. Discounted at WACC. So like that. Okay, what are we saying? Let us say the cash flows are 1 million. Okay, the cash flows are 1 million and the WACC is 10%. All right, the WACC is 10%. So if we punch these figures, in our calculator, 1 million divided by 10%, we are going to say the company is worth 10 million. Now, what if the cash flows are still 1 million, but the WACC is now 5%? We have reduced the WACC. The WACC is the weighted average cost of capital. So we have moved from 10% to 5%. What is going to be the market value of the company? Okay, the market value is going to be 20 million. So which means this is consistent with the wealth maximization philosophy, the shareholder wealth maximization philosophy. So C is correct. The lesser the WACC, or the lesser the cost of capital, the greater the wealth of the shareholders. Now, maximizing earnings per share. Maximizing earnings per share is just the same as profit maximization because earnings are profits, right? So it's again not the answer. So that's it for now. Identify by clicking on the relevant box in the table below whether the following statements about the Miller or cash management model are true or false. Number one, the greater the variability in cash flows, the greater is the spread, the upper and lower cash balance limits. When short-term investments are liquidated, the company's cash balance should return to the lower limit. If interest rates rise, the spread between the upper and lower cash balance limit rises. Okay, now I think to answer this particular question, we would need to understand what we are talking about. Okay, for this we need to refer to the formula, and the formula is also given. For us to attack this statement, if interest rates rise, the spread between the upper and lower cash balance limits rises. So let us go to the formula to see what will be going on. Okay. Yes, we need to keep. Let me look for there. Okay, so this is the Miller O model. So you're going to be given the formulas. Okay, now for us to calculate the spread, this is where the interest is. We're having the interest as the denominator here. The interest is the denominator. So just using mathematical sense only, just using the mathematical sense. If interest rates rise, the spread between the upper and lower cash balance limits rises. Is this true? Okay, let us work this problem mathematically. Let us just think mathematically. We are saying, let's say we are calculating the spread. Spread is equal to 8/2. Okay, let's say the 2 here is the interest. So in this case, the spread will be 4. What about if we say the spread, the numerator is 8, but the denominator has now become 4. What is going to become of the spread? The spread is now going to be 2. 8/4 is equal to 2. So if interest rates increase, the spread is going to be lower. It's going to go down. So obviously here we have found that the answer is false. Mathematically, just mathematically. Some of these things you just need to reason mathematically. Okay, but okay, let us then discuss why we are saying that the interest rates, the spread will fall. The increase of the spread is going to be due to the variability. Okay, due to the variability of cash flows. All right. Now, if interest rates rises, there is going to be, motivation for spending. Okay. Okay. Actually, if interest rates increase, the spread will fall. Okay, the spread will not rise but fall. The reason here is that consumers will demand less of loans, okay? Consumers will demand less of loans because they are now expensive, okay? The loans will be, will be more expensive. Again, if interest rates rise, it means the spending would be lower. Spending will be lower. Okay. In this case, um, people would be less likely, you know, want to borrow money for any expense for spending. Okay, and this will shrink or will reduce the spread or the variability of the cash spread. So this formula or this model actually takes into account the macroeconomic uh, variables. It will consider those variables like interest uh, in its computation, which means um, an entity's cash balances is also going to be influenced by such variables like interest. So the higher the interest, the lesser the spread, in the sense that there is highly likely to be, the need for people to just save what they have. Okay, they are highly likely to deposit more in the bank rather than to spend. Why? Because in the bank, because of high interest, there's also high likelihood that the deposits will fetch more returns. So in that case, customer spending will be less, but saving will be high. Okay, saving, they would need to make some savings in the hope that the return on savings is going to be high. All right, but the question was actually requiring you to understand some mathematics of the model. All right. When short-term investments are liquidated, the Karma's cash balances should return to the lower point. This is not a standing rule. However, let me draw this model so that you understand what we are talking about. Okay, that's the formula for the model. Okay. Right, on this little space, let me try to draw the model. Okay, ladies and gentlemen, this is the cash balance and this is the time. All right, there is what is called the lower point. And the return point. And the upper limit. So the return point is usually the target point. Okay, so you will discover that our spending will be sometimes follow this pattern. Okay, okay, something like that. So what happens is this statement applies. The lower limit is set by management depending on how much risk of cash flow the firm is willing to accept. And this in turn depends on both access to borrowings and the consequences. So management sets this particular lower limit. Okay. Okay, let me look at a pen. All right. Now, how does this model work? The idea is that management would set a lower point, like for example, this point, okay, which means in the course of trade or of business, when the cash balances reach this point, management would have to sell some marketable securities which they would have bought or would have bought to invest on the short-term market. Okay, so they would have to sell those securities to get more cash to trade. All right. Now, when the cash moves, all right, it reaches to this point, which is the target point. Okay, the idle point. However, the cash might rise again to reach this point. This point is just the same as this point. Okay, so when it reaches this point, it means that the firm is now some surplus cash, the allowed surplus, the allowable surplus cash. Okay, now that cash, when it reaches that particular point, it might mean that it is sufficient enough to buy more other marketable securities. So the firm would then sell the excess cash until it comes to this point, which is the idle point. However, the cash might as well drop to this point, which means the firm would then be required to sell those marketable securities so that they get the cash to trade again. So it's an ongoing thing. However, the question which we are confronted with is when the short-term investments, those marketable securities, are liquidated, the Kama's cash balance should return to the lower point. Now, when we liquidate the short-term investments, it means we are getting more money. Okay, but on the model, if we are moving to a lower point, if we are moving this direction, it means we are not having more money, but we are having less of the money. Are we together? So if we liquidate, it means we are actually going the opposite direction. This is the direction. If we are liquidating a security, it means we are getting money. We are moving from the lower point to either the return point or the upper limit. Are we together, ladies and gentlemen? So this is the reason why this is false. Are we together? Good. Now let's try this last one. The greater the variability in cash flows, the greater is the spread between the upper and lower cash balance limits. This is again a mathematical issue. Why? Because variability has to do with variance or standard deviation. Okay, so if we go to our mathematical model, we can see that there is this item called variance. So the greater the numerator, the greater the spread. Okay, just look at this particular example here, which we did. The numerator was 8, and we determined that the spread was this much. Okay, but you can also see that if the numerator becomes 10 and the denominator is 2, it means the spread will be 5. So the greater the numerator, the greater the spread. Are we together? Good. So you can see that this was true. So that's how you were supposed to have ticked that box. Now let's talk of this last question, and this question was adopted from the ACCA, the Kaplan-ACCA FM text. The minimum cash balance of $20,000 is required at Miller or Co, and transferring money to or from the bank costs $50 per transaction. Inspection of daily cash flows over the past year suggests that the standard deviation is $3,000 per day and hence the variance, that is standard deviation squared, is 9 million. The interest rate is 0.03% per day. Calculate the spread between the upper and lower limits, the upper limit, and the return point. So we have these formulas, ladies and gentlemen. The return point formula is this much and the spread is that much. So now when you calculate, when you have the return point and the spread is this distance. Okay, the distance from, the distance between these 2 points. That's the spread, or this much. Between the distance between the upper and lower limit, that's the spread. Are we together? Good. Okay. Okay, so we are given the information about the lower point. Okay, the lower point from the question is the minimum cash balance, which is required by the company, is 20,000. So we know that the lower point is $20,000, but we do not know the spread. So let us calculate the spread, and we have the formula for the spread. This is the spread formula. Okay, spread is equal to 3 multiplied by, in brackets, 3/4 multiplied by transaction cost multiplied by variance of cash flows over interest rates, close bracket, to the power third. So you need to get into the examination hall, being able to compute that figure. So spread is equal to 3, big bracket, 3/4. Okay, 3/4 multiplied by okay, you need to multiply it with the transaction costs. All right, and the transaction cost was $50 per transaction. All right, so we need to slot in the $50 multiplied by the variance. So in the examination, you might be given the standard deviation. If you are given the standard deviation, it means that the variance will be standard deviation squared. Okay, and you also need to pay good attention that the variance is given in daily terms. Okay, it should be in daily terms. So if you are given an annual standard deviation, it means that you need to make it, or to reduce it to daily standard deviation. And the examiner, in that case, they will give you, they will tell you if it was a 365-day year or a 366-day year. They will tell you that. So you need to then moderate to ensure that the variance becomes a daily variance. Okay, that said, let's continue. So we are told that the variance in this case was 9 million. That is 3,000 squared. That's 9 million. So 9 million. Okay. Then you also have to then know that the formula is fully complied with. Just have to make sure. Okay, if you're happy with the formula, You continue, you proceed. All right, so the interest rate from the question is 0.03%. 0.03% is written this way. Okay, if you want to put it into decimal. All right, not just 0.03. You'll be wrong. Okay, to the power third. Just make sure that you patch that as a power. If you just multiply the bracket by a third, you are going to get a wrong answer. So your computation should produce this spread of 31,200. Then what else do we need to, okay, so we now have the spread. The spread is 31,200. Okay, so the spread 31,200. Do you think it is now it is still a problem to determine the upper limit if we now know the lower limit and the spread? Obviously, the upper limit should be 31,200 plus 20,000, and this means that the upper limit is now $51,200. That's the upper limit for us. Now, we can't then guess the return point. The return point doesn't mean that it's the middle figure. Okay. All right. So you need also to do some arithmetic. The formula for the return point is this one. So return point, the return point is from the formula sheet, lower limit plus a third term spread. Lower limits okay, lower limits plus a third times spread. Cross check. Yes. So the lower limit was 20,000. Okay, plus a third times spread. So we know that the spread is 31,200 multiplied by a third, simply just say over 3, and we get 20,000 plus, let us use the calculator, 31,200 over 3, that's 10,400. So this should be 31,0400. Sorry, 310. Yeah. Okay, that's the danger of mental work. I ended up producing 310,400. Okay, this is 30,400. Please be with me there. Okay, so that was our return point. So sometimes you might try to, so we are saying the return point is 30,400. And the upper limit we are determined it to be 51,200. Okay, That's the correct figure there. But let's say you wanted to be very, arithmetical about it. Were you going to come to the to the same conclusion or to the same return point value? Okay, let's say we know the lower point and the upper limit, and we then say, okay, fine, the spread was, we're just trying to do the trial and error here. The spread was 31,200. So if we had divided it by 2, we would maybe know the middle figure, and the middle figure of the spread was going to be over 2, that's 15,600. So if we add 15,600 and the lower limit of 20,000, we were going to rest at 35,600, and you can see that we were going to be very, very wrong. So, ladies and gentlemen, that 35,600 for the return point could be a distractor in your exam. Do not follow that route. So this is the long route. The formula should be this as given for the return point. There's no easy way around it. Okay, good. So here are the basic tips which you might accommodate as part of your preparation for this upcoming ACCA financial management exam. You should read the question carefully and follow the instructions on how to answer the question. For example, if a question asks the candidate to select 2 correct statements, then marks can only be awarded if 2 statements have been selected. So which means if you select 1, when the question says select 2, you're going to fail. If you select 3, when the question says select 2, you're also going to fail. In addition, when answering a number entry question, candidates must ensure they are entering their answer in the correct format as stated in the requirement. If a number is being requested in millions, there will be an M after the number entry box. If a candidate puts a full answer of say 13 million in the box rather than 13, this will be marked as incorrect. Be careful there. If there is no format specified, answers may be given as an integer, that is the full 13 million, or to 1 or 2 decimal places, that is if the number had some decimals. Just have to round it to 1 or 2 decimal places. The exam system is configured to allow any correct answer under this format to be awarded the available marks. So they would have actually configured their system to ensure that students who have entered 13.1 or 13.12 to get their answers correct. So there is no way you are going to say the examination was not fair, because you are being warned beforehand that you should be careful. Okay, so ladies and gentlemen, this was all from me to you. So I expect, ladies and gentlemen, you're going to subscribe to the channel. You're also going to consider being part of our student pool so that we continue to grow together. Until next time, ladies and gentlemen, may you continue to feel excited, and I mean it. You need to feel very, very excited. Please be with me. Also continue with me on this revision journey as we will be attacking section B and section C type questions. So just hang on, just click on. Um, just continue to hover around. Okay, hang on as you are going to be taken to the section B part of this presentation, section B and section C. Okay, so continue to click on. Okay, I'm signing up. Bye.